Would you buy a stock just because it pays a 7% dividend? Well, I wouldn't. A good dividend investor needs to look beyond the dividend itself. So, today I'm going to show you the 7 things I personally look at before considering a dividend paying company for my long term portfolio. And number 7 is something I believe many dividend investors overlook. So, hello everyone, and welcome back to Suujish Dividends and to another episode of Dividend Diaries. Over the last 6 episodes, we have talked about dividends, passive income, dividend yield, payout ratio, and the important dates surrounding dividends. Today, we are putting all of that together. I'm going to walk you through my personal framework for evaluating the dividend stocks. So, let's get started. Number one, I start with the business. Before I look at the dividend, I want to understand what the company actually does. What does it sell? How does it make money? Is the business understandable? Does it have a competitive advantage? And most importantly, do I believe the business can remain relevant for many years? Because remember, when you buy a stock, you are buying a small ownership stake in a business. I don't want to own a dividend. I want to own a good business that happens to pay dividends. So now, number two, profitability. A company needs to generate profits if it wants to consistently reward its shareholders. So I look at the company's earnings history. Are profits generally growing? Are they stable? Or are they declining and becoming unpredictable? Now, one bad year doesn't automatically makes a company a bad investment, but a long-term pattern of deteriorating profitability can definitely deserve, must definitely deserve an attention. Next, number three, cash flow. This is extremely important for every dividend investors. A company can report accounting profits, but dividends ultimately require cash. So I want to understand whether the business is generating healthy cash flow and whether that cash generation supports the dividend. This is also why I don't rely on just one financial ratio. I want to see whether the company's actual financial position supports what it's distributing to its shareholders or not. Then comes number four, the dividend history. If I'm looking for a long term dividend investment, I want to know how the company has treated its shareholders in the past. Has it paid dividends consistently? Has the dividend been stable? Has it grown over time? Have there been any frequent cuts or interruptions? See, past dividend payments don't guarantee future dividends. Remember that. But a long and consistent history can tell us something about the company's approach to returning capital to its shareholders. Now, the next is number five, payout ratio. And we've already discussed this in episode 5. I want to understand how much the company's earnings are being distributed as dividends. That's what payout ratio is about, right? A very high payout ratio can leave less room for the company to retain earnings and handle difficult periods. But I also don't believe there's one magical payout ratio that makes every company good or bad. Different industries and business models can have different characteristics. So I look at the payout ratio in context. Then comes number six, debt and financial strength. Now, debt isn't automatically bad. Companies can use debt intelligently to grow their businesses, but excessive debt can become a problem, particularly when interest costs rise or business conditions become difficult. So, I want to understand how much debt does the company have? Can it comfortably service that debt? Is its balance sheet getting stronger or weaker? Because sustainable dividend investing requires more than just a good looking dividend. Okay. And here comes finally the number 7, valuation. Even an excellent company can become a poor investment if you pay an unreasonable price for it. So, after evaluating the business and its fundamentals, I ask to myself, is the current stock price reasonable relative to the company's earnings, cash flows, growth prospects, and overall quality? See, a great company at an excessively high valuation may not provide an attractive investment opportunity. You need to know that. And a lower stock price doesn't automatically mean a stock is cheap. Sometimes a stock is cheap for a very good reason. That's why valuation comes after understanding the business, not before it. So overall, my basic checklist looks like this. The first one is business quality. Second is profitability. Third is cash flow. Fourth, dividend history. Fifth is payout ratio. Sixth, debt and financial strength. And seventh one, valuation. And I don't expect every company to look perfect on every single metric, because investing is about understanding the overall picture and the risk involved in it. And there's one more thing I want you to remember as a dividend investor. Don't build your investment thesis around the dividend alone. If the underlying business deteriorates, a high dividend won't magically make it a good investment. The dividend is just one part of the story, but the business is the real story. So that's it in today's video. In the next episode of Dividend Diaries, we are going to talk about something that can make a huge difference to your long-term dividend income, and that is dividend growth. What's the difference between a company paying a high dividend today and a company that can potentially increase its dividend year after year? I'll help break it down next Sunday in the most simple way possible. So, if you are enjoying this journey, subscribe to my channel Suujish Dividends and join me every Sunday at 10 a.m. Until next time, remember, we are building wealth one dividend at a time.